series, and that we're in a few weeks or months of consolidation in dollar terms. But if that lasts, I don't see it lasting beyond August. And what is it, May 25th? So 2.5 months. I guess you could call that consolidation.
Right.
But it might not be. But what I'm really looking for is August, when the federal government, when the Treasury runs out of money. I mean, then what happens? Well, then they have to raise money. The question is, where are they going to raise it from? The answer is always they have to raise it from bank reserves that are available. But there are no more bank reserves that are available because they're all being used to fund the repo market. So somebody's going to have to come in and print dollars, and usually that's the Fed, or a bunch of drug dealers that are counterfeiting cash. But I don't think they could do nearly as much as the Fed could do. That would really inflate the price of drugs and stuff. It's not going to happen. So we gotta wait for the Fed to step in here. And once the Fed steps in for one last time, we could be in the parabolic phase. So that's the thing about hyperinflations.
The speaker believes that any current consolidation in gold, in dollar terms, won't last past August, when the US Treasury is expected to run out of funds. Gold prices struggled as the US dollar rose slightly. This was due to concerns about China's economy, US-China trade tensions, and geopolitical risks. At that point, the government will need to raise funds, but with bank reserves already tied up in the repo market, the only option will be for the Federal Reserve to print more dollars. Once that happens, it could trigger a parabolic move in gold prices and push the economy toward hyperinflation. JP Morgan forecasts an average price of $3,675 per ounce by Q4 2025 and anticipates prices could surpass $4,000 by mid-2026, driven by ongoing recession risks and strong demand from central banks. The speaker, Rafi Farber, a financial commentator, investor, and advocate for precious metals, questions the notion that gold is merely in a consolidation phase. The gold market remains in a cautious flux, shaped by economic indicators, geopolitical developments, and seasonal dynamics. Fed Chair Powell's remarks on financial strength and inflation have created a mixed environment of optimism and uncertainty. The consolidation within the ascending channel reflects the market's indecision. December's thin liquidity and fluctuating price movements further complicate short-term trading, requiring a focus on key levels and disciplined strategies. Despite these challenges, the broader bullish trend signaled by patterns like the inverted head and shoulders offers optimism. Traders prepared to adapt to the evolving landscape can capitalize on this trend. Rafi Farber argues that a specific group isn't deliberately manipulating silver prices. Instead, the suppression is systemic, because modern currencies like the US, Canadian, and Israeli dollars are all derivatives of silver and gold. By holding these fiat currencies instead of physical silver or gold, everyone is effectively short on precious metals. As long as people continue to hold dollars, silver remains undervalued. But once confidence in the dollar collapses, silver will soar in value, and we may return to using it directly for transactions. As we dive into the video, remember to subscribe and tap the bell icon so you never miss an update. We value your thoughts, so drop a comment below and give us a thumbs up if you enjoyed the content.
Always know that the most important thing is to always trust the experts, no matter what they say. So if the experts are saying that gold's going to be in consolidation, then that's what you have to believe.
Right.
I don't think so. Yeah, it depends what you mean by consolidation. It depends what ratio you want to look at, what metric you want to look at. If you're just looking at dollars and gold, the dollars and gold relationship, then maybe we're in a consolidation. But then again, you have the gold to S&P ratio, and that we're in a few weeks or months of consolidation in dollar terms. But if that lasts, I don't see it lasting beyond August. And what is it, May 25th? So 2.5 months. I guess you could call that consolidation.
Right.
But it might not be. But what I'm really looking for is August, when the federal government, when the Treasury runs out of money. I mean, then what happens? Well, then they have to raise money. The question is, where are they going to raise it from? The answer is always they have to raise it from bank reserves that are available. But there are no more bank reserves that are available because they're all being used to fund the repo market. So somebody's going to have to come in and print dollars, and usually that's the Fed, or a bunch of drug dealers that are counterfeiting cash. But I don't think they could do nearly as much as the Fed could do. That would really inflate the price of drugs and stuff. It's not going to happen. So we gotta wait for the Fed to step in here. And once the Fed steps in for one last time, we could be in the parabolic phase. So that's the thing about hyperinflations. They're always in gold terms, and towards the end stages, people are looking for consolidations, and they just never come.
Right.
So yeah, we could see consolidation, and then another advance, and then another consolidation, which is even shorter, and then another advance, which is even bigger, and another consolidation, which is even shorter. Because if you take the logic all the way back to what the dollar began as, it began as a silver derivative. Now,
Right.
even before it was a gold derivative, it was a bimetallic derivative of gold and silver, and gold and silver were locked in at a ratio of 15.5 or 16.2 or whatever it was. to 1 statutorily. So from that, you have what a dollar is. And because of the regression principle, the Misesian regression principle, Mises made this clear, you have to go back in time in order to give any meaning to prices, or else prices are just arbitrary numbers. And then if they're arbitrary numbers, you can't divide resources based on arbitrary numbers. They have to reflect some kind of a reality, and therefore prices have to reflect some kind of reality in the past.
Right.
Now, the point of saying all this is that anyone who owns a dollar in their wallet or in their bank account or anything like that, or a Canadian dollar in their bank account, because the Canadian dollar, the Bank of Canada owns no gold, and therefore the Canadian dollar is a derivative of the US dollar because the Bank of Canada owns dollars. Same thing with the Bank of Israel. Where I live, the shekel is a dollar derivative entirely. Where you live, the Canadian dollar is a dollar derivative entirely. If you own that currency, you are short silver. You are short gold also, because you have elected to own their derivative of gold and silver instead of gold and silver directly. Therefore, you have sold your gold and silver and taken their liability instead. So you're short silver, you're short gold, I'm short gold because I still own some dollars and I don't have $0, so I'm short silver. Right. Everyone who owns dollars is short silver. So what's the mechanism? The mechanism is everybody. Everybody's short silver, and when nobody's short silver anymore, that means that silver is infinite amount of dollars, and that means dollars are worthless, and instead we buy stuff in silver ounces instead of dollars because the dollar doesn't mean it.
While industrial demand for silver matters, monetary demand is far greater, especially when credit systems fail, as everyone needs money to survive. Eric Sprott, Phil Baker, and Michael Oliver joined Simon Catt to discuss the outlook for silver and the potential for a breakout to $200. In a future where silver becomes a form of money again, industrial use would likely add to demand, potentially driving up prices. However, in an industrial society, increased demand is usually met with increased mining and supply. So, even with high industrial and monetary demand, supply can keep pace, keeping silver's value stable around a historical ratio of 15-to-1 compared to gold, similar to the pattern seen before the 1970s. Rafi Farber doesn't give financial advice but shares their strategy. They hold enough silver, a few hundred ounces, to get through a potential dollar collapse, about a year's worth for their family. Because silver is highly volatile and emotionally stressful, they also hold gold to stabilize their portfolio. Gold is more stable and steadily increases in value, helping them sleep better. Their approach is to use silver for the crisis itself and gold to preserve and transition wealth afterward.
I was thinking about this, and usually I just brush it off and say, industrial demand doesn't matter because the monetary demand is so much more gargantuan than any industrial demand.
Right.
Because industrial demand is only demanded by certain industries for things, for certain products, whereas monetary demand, when credit does not work, is everybody on the planet. Because everybody needs money or they're going to die.
Right.
So then I was thinking, so if we're on a silver standard and we have honest money, we're in that world, and industrial demand goes up, then that should bring the silver price even more expensive, because if you need it for money plus industry, then silver should be even more expensive since the demand is going in two ways.
Right.
One for consumption and one for monetary. However, when you have an industrial society, the extra demand for silver in industry should be matched by the increase in production of silver that industry affords, right? Because if you are an industrial society, you're much better at mining silver out of the ground. So
Right.
the increase in the supply of silver should balance out with the increase in demand for silver that industry itself demands. Right? I don't know if it's exactly going to balance out, but I'm saying as demand increases, supply also tends to increase in an industrial society. So that balancing back out, when the dollar is dead and when we're back on silver as money for however brief period it's going to be before we can rebuild the credit system, that should keep the monetary ratio at somewhere around 15-to-1 for that emergency period. Whereas you could say, because an industrial demand is so much higher, it's going to be lower than that.
Right.
So it's going to be even more expensive. I'm going to say, no, it's not going to be lower than that, because we're still an industrial society where the ability to mine silver out of the ground is much higher. So I think in the end, it evens out that the increased demand for silver will be matched by the increase in supply of silver that we've been able to mine over these past few years, decades, half a century, or however long you want to define the Industrial Revolution. Then we should be looking at somewhere around a 15-to-16-to-1 ratio, as it has been since the 19th century until until the 1970s, basically, or the last time we hit the 15-to-1 ratio, which was 1980. The advice that I don't give any advice, but what I do for myself is that silver's price swings make me nervous.
Yeah.
Not that I'm emotionally disturbed by them or that I ever have any doubts that we're eventually going to reach the end game and hit a 15-16 to 1 ratio. I still know that. But
Right.
it doesn't mean that I'm immune to price swings. And whenever silver goes up, I'm like, ooh, look how many dollars I have in my account now. And whenever it goes down, I'm like, oh no, I lost like 50% or whatever it is. Doesn't matter.
Right.
And it still affects me. And I don't want that to affect me. I'd rather just stay calm. So I have a certain amount of silver that I think I need necessary to get me through the end game, to get me through the end of the dollar, which I think is about a year's supply for my family. A few hundred ounces for me and for my kids and I, and if we never get there, I never have to spend them. So I'll sell them and give it to my kids,
Right.
whatever it is, and for just to keep my fiat totals steady and just edging up and then slowly down, then edging up and slowly down instead of going roar, 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 like silver does.
Right.
Right. So I have gold for that, and that balance keeps my portfolio somewhere in the middle. Some days it's more volatile, some days less, but it keeps inching up because gold keeps inching up higher and higher and higher. And
Right.
silver will, but I don't want to live through those volatile moments and not be able to sleep. I want to be able to sleep. So I would say get some silver to get you through the end game for when the actual thing happens, and use gold to get to the other side of it. For the other side, you'll need your gold.
Rafi presents a compelling argument for holding physical gold and silver as a hedge against a collapsing dollar and an unstable financial system. They emphasize that while silver may be volatile, it plays a crucial role during systemic crises, whereas gold provides long-term stability. With potential monetary shifts on the horizon, especially by August, the speaker believes we may be approaching a historic turning point where real money, gold and silver, reclaims its role. Do you think the average person is prepared for a sudden shift away from fiat currency? How would a return to gold and silver as money impact daily life and the global economy? Share your thoughts in the comments below. We'd love to hear from you. If you found this helpful video, don't forget to give it a thumbs up and subscribe for more content.